As of today, Saturday, May 9th, 2026, the stock market is officially closed for the weekend. SoFi stock finished its last regular trading session on Friday, May 8th at a closing price of $15.75, which represented a decrease of 1.56% on the day. However, looking at the after-hours activity that followed, the stock saw a slight recovery, nudging up to $15.82 by the time the extended session wrapped up at 8 p.m. EST. While a 7-cent gain might seem like a rounding error to a casual observer, the underlying story here is actually far more complex than the daily ticker movement suggests. Most people looking at SoFi stock right now are focused on the immediate fallout from the recent first quarter earnings report. The standard narrative is that while the company hit its numbers, the market was spooked by what many perceived as a lack of aggressive guidance for the back half of the year. But here is where the reality begins to diverge from the common expectation. While the headlines focused on a temporary dip after the release, the actual data shows that SoFi has just delivered its second consecutive quarter with over $1 billion in cash revenue. That is a massive milestone that puts them in a completely different league than the typical fintech startups they are often compared to. Most investors expected a slowdown in member growth as the market saturated, but the reality is that SoFi added a record 1.1 million new members in just 3 months, bringing their total to 14.7 million. If you were looking at the general sentiment, there is a lot of noise about whether SoFi is a bank or a tech company. The expectation is that they will eventually be valued like a traditional financial institution, which would mean a much lower price-to-earnings multiple. However, the deeper take is that SoFi is successfully transitioning into a platform as a service provider through its technology segment. This is why tools like the SoFi trading platform and sofiinvest are so critical. They aren't just features, they are the top of a funnel that brings people into a high-margin ecosystem. When you look at their financial services segment, net revenue grew 41% year over year. That is not the growth rate of a boring old bank. That is the growth rate of a tech giant in its prime. The tension in the market right now is palpable because institutional activity has been shifting. Large funds are starting to treat this stock with a level of seriousness we haven't seen in previous years, while many retail traders on the Robinhood app, or those looking for quick investment help, are chasing daily swings. The big players are looking at the GAAP net income of $167 million. This wasn't just a small beat, it was a 134% increase compared to the same period last year. The expectation was that high interest rates would eventually crush loan demand, but the reality is that SoFi just had its best quarter ever for loan originations at $12.2 billion. They are finding ways to grow even when the macroeconomic environment is working against them. Think about how often you hear people talking about shifting their portfolios into safer bets. There's a lot of talk about Schwab intelligent portfolios, or moving into Fidelity ETFs and Fidelity mutual funds for stability. That is a valid strategy for some, but it overlooks the sheer momentum of the everything app strategy that SoFi is executing. They are no longer just a student loan company. They have successfully diversified into personal loans, home loans, and a massive credit card business. If you are someone who likes to invest online or prefers self-investing through an individual brokerage, you have to look at the cross-buy rate. Almost 43% of new products in the first quarter were bought by existing members. That is the holy grail of financial services, getting more revenue from the people you already have without having to spend more on marketing. Compare this to other investing sites or the interactivebrokers trading experience. Those platforms are fantastic for power users, but they don't capture the entire financial life of the user the way SoFi does. When a user logs in to check their SoFi stocks, they're also seeing their savings account, their insurance options, and their credit score. This creates a level of stickiness that traditional Fidelity brokerage or Fidelity wealth management accounts struggle to replicate for the younger demographic. The market expects SoFi to eventually hit a ceiling, but the reality is that their total products increased by 39% to 22.2 million. They aren't just growing, they are compounding. Let's talk about the competition for a second, because that is where the expectation versus reality gap gets even wider. Many people think Robinhood stock trading or the Robinhood app is the primary rival. While they compete for the same attention, SoFi has a banking charter that changes the math. Because they can hold deposits, which reached the record levels this quarter, they have a lower cost of capital than almost any other fintech. This means they can offer better rates on SoFi Money while still maintaining healthy margins. While others are struggling with the fees associated with interactivebrokers fees or complex pricing structures, SoFi is keeping it simple and capturing the mass market. I want to pause here for a second and get your take on the direction of these digital-first banks. Comment below how many shares of SoFi you currently hold, or if you're still sitting on the sidelines waiting for a better entry point. It's interesting to see how different the community sentiment is compared to the institutional price targets we're seeing right now.
Looking at the technical side of the recent movement, we saw a lot of volatility around the $16 mark. The stock has been bouncing in a range that suggests a consolidation phase before the next major catalyst. Trading volumes have remained high, which indicates that there is plenty of liquidity and interest, even if the price is currently stuck in a tug of war. Institutional activity shows that some of the largest wealth management firms are slowly building positions, often hedging them with Fidelity IRAs or other long-term vehicles. This tells me that the smart money is preparing for a multi-year hold rather than a quick flip. The business model itself is where the long-term authority of the company is built. SoFi operates through three main segments: lending, financial services, and the technology platform. The lending side is the cash cow, but the financial services side is the growth engine. In the first quarter of 2026, the financial services segment actually became a significant contributor to the bottom line, which is a major shift from a few years ago when it was a loss leader. This is the part of the analysis that many people miss. They see the lending numbers and worry about credit quality, but they ignore the fact that the technology platform, which includes Galileo and Technisys, is being used by other banks. SoFi is essentially building the AWS of Fintech. Looking at the future outlook, there are several catalysts on the horizon. The expectation is that as the Federal Reserve eventually moves towards a more neutral stance, the mortgage market will reopen in a big way. Reality might be even better, as SoFi has already spent the last 2 years optimizing their home loan process to be much faster than traditional banks. If they can capture even a small percentage of the refinancing wave that is expected in the coming years, their revenue could see another massive leg up. Additionally, their expansion into digital assets and more sophisticated investment products through SofiActiveinvesting is starting to attract a higher net worth client base. There are, of course, risks that we have to acknowledge. The reality of being a bank is that you are sensitive to credit cycles. If the economy takes a sharper downturn than expected, loan defaults could rise. However, SoFi's member base has a much higher average income and credit score than the national average. This is their primary defense. They aren't just lending to anyone. They are lending to high earners who are not well served by traditional banks. This focus on the high-quality borrower is what allows them to outperform even when the broader sector is struggling. As we look towards the next few quarters, the gap between what the market expects and what SoFi is actually achieving will likely continue to create volatility. Investors who are used to the simplicity of Apple stock or the steady growth of Nvidia stock might find the fintech space a bit more stomach-churning. But for those who understand the shift towards digital-only banking and the power of a unified financial app, the story is incredibly compelling. You see similar moves in Tesla stock where the valuation is based on future potential as much as current earnings, and SoFi is starting to command that same kind of forward-looking respect. Whether you are using the fidelitymobileapp to track your long-term retirement, or you are actively trading on the Robinhood app, the importance of SoFi in the current market landscape cannot be overstated. They have proven they can be profitable, they have proven they can grow in a high-rate environment, and they have proven that their members are incredibly loyal. The expectation was that they would be a flash-in-the-pan fintech company that burned through cash. The reality is a profitable, diversified, and technologically superior financial powerhouse that is just starting to hit its stride. In summary, the contrast between the recent 1.56% dip and the record-breaking fundamentals is a classic example of market noise obscuring a clear signal. SoFi is executing at a level that very few people predicted 2 years ago. They have met the challenge of profitability and are now focusing on scaling that profit into something much larger. The authority they have built in the lending space is now being used as a springboard into every other area of finance. As the market reevaluates the fintech label and starts looking at SoFi as a leader in the next generation of banking, the current price levels might be looked back upon as a significant period of consolidation before a much larger move. The reality of their $1.1 billion quarterly revenue and $167 million net income is a loud answer to those who doubted their business model. Expect the volatility to continue, but don't lose sight of the fact that the underlying engine is running better than ever. The depth of their ecosystem, from SoFi robo-advisor services to their institutional-grade technology platform, provides a foundation that most of their competitors simply cannot match. It is a story of a company that refused to stay in its lane and is now reaping the rewards of that ambition. For any serious investor, the balance between these high expectations and even higher reality of their performance is the most important trend to watch in the coming months.